Welcome back. Investors are on Fed watch this week ahead of Jerome Powell's annual Jackson Hole speech this Friday. They're hoping for any clues into whether the central bank may finally start to cut those rates. The speech coming at an especially pivotal time as tariff tensions drag on and the labor market has shown some signs of slowing. Not to mention, President Trump hasn't let up on his pressure campaign when it comes to Jerome Powell. Just this morning, Treasury Secretary Scott Bessent said interviews for an incredible group of potential Fed chairs will start after Labor Day. So as we close in on Jackson Hole, we're reminded in years past that news definitely comes out of this conference. All the financial networks will be covering it, Mark Tepper, including us. But my question to you is, does it matter this year? Is Jerome Powell a big, fat, lame duck?
I do think it matters. Okay. I think, right now there's an 83% chance of a September rate cut. I think we need that. I mean, we certainly have some situations here in the United States that are problematic. You look at the fact that housing is the least affordable it's ever been. Right now, existing homes are $33,000 more than new homes. Like, that just doesn't even make sense. But that's due to the fact that people locked in 3% mortgages a few years ago, and they're unwilling to sell their home and take on a 7% mortgage. Businesses need affordable capital to access so that they can purchase machinery, so that they can execute on growth plans, so that they can hire people. We need a lower cost of capital. And if you remember back at Jackson Hole last year, Powell did make a bit of a dovish pivot right before he rolled out that 50 basis point bazooka cut the following month. I would expect that despite the fact that we had a one-time pop in the PPI number, hopefully he thinks that's transitory. He told us for years and years and years, and they make the decision to cut and give us at least a 25 basis point cut.
Brian, do you think he'll do it, or you think he's going to dig his heels in? Just because of Donald Trump.
Okay, so I am not the guy you typically hear saying that Powell's super political and it's all despite Donald Trump. I'm not saying that's not true, but I usually don't say that. But I think he's going to try very hard at this meeting to say nothing that suggests a rate cut is coming. I think he is going to be, what's an animal that just sits on the eggs, and if you get anywhere close, it'll just, like, you talked about a lame duck. He's not a lame duck. He's like a mother hen on the eggs, right? And he doesn't.
That was really interesting. I'm not.
Is that interesting?
Yeah,
You like that?
going with that.
But keep going.
Because I think a little bit of the political animosity is taking over in him. I think it's going to take over in the next few months. And I think at this meeting, he's not. President Trump is going to want him to say the time for cutting is now, and Powell's not going to give that to him. Even if they decide to cut in September, he's going to studiously not say that in Jackson Hole, because I think a little bit of that spite is going to operate
Do
here.
you think, Marcus, he still goes along with the same narrative, which is tariff trouble is coming, I'm waiting for it, it's coming,
Tariff trouble is here. Debt to income is the issue that he needs to solve for. And he was talking about, I want to make capital cheaper for companies. I agree. I'm one of those people. But debt to income is the thing we don't talk about. We talk about discretionary dollars. Discretionary dollars come when your debt is lowered, not in its principal balance, but in its monthly variable balance. And the only way to have the thing be a soft landing for consumers is the tariffs are there. How do you hurdle it? You bring the variable payments down in my house and in your house, and you give me the discretionary dollars to be able to absorb it.
Okay.
Big difference.
That sounds like cutting interest rates to me.
It's cutting interest rates, but
I'm trying to interpret that.
But cutting interest rates for the knowledge that the consumer is suffering and the tariffs are not going away.
Yeah.
One thing I mentioned in the commercial break is that there were 71 corporate bankruptcy filings in the month of July, and that surges past the pandemic high. The total number for the first 7 months of this year is 446. I can go through a lot of the companies that have filed, but several high-profile bankruptcies, Del Monte Foods, did Rite Aid file for bankruptcy? I don't want to say that.
Over-leveraged high rates, period.
Right, but you said that the revolving debt is also a huge problem.
That's right. Revolving debt for corporations is massive today. I look at some of my businesses, and I have if you have $1 billion of debt, a quarter of a point's a big deal.
Yeah. I'm also worried about commercial real estate for that reason, too. People who have adjustable rate mortgages have been saying to me, I don't know how much longer I can go. And that's something that President Trump would have his eye on and a good pulse of, too, because he's a real estate guy.
You know, I think it's important when we're talking about tariffs and the potential inflation for us to understand the scope and magnitude of what worst-case scenario could look like for consumers if 100% of those tariff costs were actually passed on to consumers and not eaten by corporations, which is not what's happening right now. But as a country, we generate $25 trillion of personal income every year. We import $3.3 trillion of goods. We are starting to narrow in on a 13 to 14% effective tariff rate on those goods, which is roughly $450 billion. All of that equates to a 1.7% tax on consumers, which has been more than offset by the One Big Beautiful Bill. So at the end of the day, if that's worst case scenario for consumers, we can deal with it.
But you got a little bit of a timing problem there because the tariff bite hits before the taxes, which is why some people said, why didn't they do the taxes first, then do the tariffs, whatever. But that's your timing problem, and that'll matter because if in the short term the tariffs bite more, then you get a guy at the Federal Reserve who doesn't want to help the president anyway. He's a mother hen. He says, I'm not going to cut rates. And
I
then
think,
you're
though,
in
in
a problem.
worst case scenario, the consumer only gets stuck with a third of the tariffs. I think that the foreign country that's sending the item over, the exporter and the importer on this side, realize they both have to do something. They've been doing maybe more than they will, but I can't see a scenario where they pass the entire cost off to your
The
point.
elasticity isn't there.
Yeah.
The elasticity isn't there. One last thing on inflation, right? Inflation typically is where demand is massively outpacing supply. That is not the inflation we're talking about today. We're saying demand isn't any higher. The cost of the product's higher. Now, is demand going to go down? That's the question.
Which would be deflationary.
Right.
In the longer run.
Which is, Deegan, what I feel like you've
Unless
always
your
been
interest
saying.
rates come down and you're freeing up dollars out of your household.
Because it becomes a tax on consumers, and then they would be consuming less if they can help it.
The tariffs are a tax. The tariffs are a sliver of a value-added tax. I don't think that it's inflationary. It's a one-time hit if it stays. And we can discuss this later, but as I predicted, the Democrats and liberals are already salivating over what has been put in place. It's not going to go anywhere, and mark my words, liberals will layer on additional consumption taxes on the American people, and we're on the road to a value-added tax and an income tax together, like Europe, to pay for.
Feels like a resort with all these other fees on top of your hotel room.
Yeah, to the ginormo entitlements of Social Security and Medicare, which Congress can't fix.
I don't want to go to that resort.
Right.
You do already.
You're already. Hey, guess what?
It's like Hotel California. I want to check out.
Yeah, exactly.
They bought all of these politicians bought you a ticket.
Yeah.
And you can't get rid of it. You're on the road and you can't get. You're on the train, so to speak, and you
cancellation
can't get
policy.
off. The one thing. The only. Mark my words. This is my prediction. I could be dead wrong. Well, not dead wrong, just cold wrong. The only reason that longer-term interest rates have not blown out to the upside, particularly given how much the deficit that we're running, which is going to be north of $1.8 trillion this year, the interest, how much we're rolling over, it's a third. In every 12 months, we have to roll over a third of the debt held by the public. And then the interest expense that we're trying to manage, $100 billion a month on average so far this fiscal year. The only reason that longer-term interest rates have not blown out to the upside is the market thinks that the Federal Reserve is controlling inflation. So if investors start to think the Fed's not on top of it, you could see a longer-term interest rates go up.
The 10-year takes off, you're in trouble.
Right.
All right, we'll be watching that